Have you ever stared at a market chart, watching the line go up or down, and just felt like you were trying to read a language you didn't understand?
Oh, absolutely. I think everyone starts there, honestly.
Right. I mean, you see the green candles, the red candles, the moving averages, the zigzags. You see price spiking 1 minute and crashing the
It's
next.
visual
Yeah,
chaos.
total chaos. So you meticulously draw your support lines, you map out your resistance levels, maybe you throw on a Fibonacci retracement, and you think, well, I have it all figured out. The setup is perfect.
And we all know what happens next.
Exactly. Out of nowhere, the market just blows right through your lines as if they didn't even exist. Your stop loss gets triggered. You're sitting there staring at a completely red screen. And get this, 5 minutes later, the market reverses and goes exactly in the direction you originally predicted.
It's the most frustrating feeling in the world.
It really is. So if you've ever felt that frustration, if you've ever felt like the market is this, completely unpredictable, chaotic beast that is actively hunting your account, you are definitely not alone.
Not by a long shot.
But what if I told you that the reason markets feel so entirely unpredictable is because, well, almost everyone is looking at the exact wrong thing?
What's fascinating here is that this common approach assumes price is the cause of its own movement. People spend years, sometimes decades, agonizing over these tiny wrong data points.
Trying to find a signal in pure noise.
Precisely. They treat price as if it has its own internal gravity, like it has its own sentience.
And that is our mission for this deep dive today. We're going to completely invert how you understand market movements. We're stripping away the illusion of price to reveal the hidden architecture operating right beneath it.
Because the standard approach, the way almost everyone is taught to look at markets from day one, is entirely backward.
It really is. Think about the typical journey for a retail trader. Most people open their brokerage app, they pull up a chart, and they just look at price first.
Right. They look for a head and shoulders, a double bottom.
A wedge, yeah. And they form this hard conclusion based solely on what that two-dimensional line on the screen is doing. And macro factors, the actual real-world global economy.
That's just treated as an afterthought.
Exactly. It's usually just a convenient excuse used to explain what already happened on the chart after the fact.
Yeah, people use the news to justify the red candle they just saw. But price is actually derivative. It's just the visible outcome of much deeper structural forces that are already in motion long before the chart even starts to move.
Okay, let's unpack this because I want to make sure we really nail this concept, but I also want to, push back a little right out of the gate here.
Yeah, go ahead.
You say price is derivative, but anyone who has studied basic market theory has heard of the efficient market hypothesis.
Ah, right. The academic holy grail.
Right. The idea that all known information, all the macro data, all the geopolitical news is instantly priced into the asset. So if that's true, why shouldn't I just look at the price? Doesn't the chart theoretically contain everything I need to know?
Well, the efficient market hypothesis is a beautiful academic theory, but it completely falls apart the second you introduce human psychology and institutional liquidity constraints into the real world.
Because it assumes too much perfection.
Exactly. The theory assumes that all participants have equal access to information, that they interpret that information the exact same way, and that they can execute their trades instantaneously without any friction.
Which is obviously not how the real world works.
None of those things are true. Price doesn't instantaneously reflect information. Price is actually the messy, delayed, often incredibly irrational process of market participants trying to agree on what that information means.
Okay, so it's not a perfect reflection of reality. It's a reflection of the participant's perception of reality at a specific millisecond in time.
Precisely that. To understand why relying purely on price is a trap, we have to look at the actual mechanics of a market. At its absolute core, what is a price?
It's just a number on a screen for most people.
Right, but mechanically, it's simply an aggregator of transactions. It is a historical record. Every single time you see price move on a screen, whether it's a stock, a currency, a barrel of oil, it's just the recording of a moment where a buyer and a seller agreed on a value and an exchange took place. That's it.
It's an output, not an input.
Exactly. It is purely an output.
I think an analogy helps here. Relying solely on price analysis is kind of like staring at your car's speedometer to figure out how the engine works.
Oh, I like that.
Yeah, because the speedometer is a highly accurate instrument. It tells you exactly how fast you're going at this very second. It tells you where the needle has been.
But it doesn't tell you anything about the amount of fuel in the tank.
Exactly. It doesn't tell you if the alternator's failing or if the transmission is slipping. And most importantly, it doesn't tell you anything about the intent of the person sitting in the driver's seat.
Yeah.
Are they pressing the gas pedal, or are they about to slam on the brakes?
That analogy holds up perfectly when you consider the limitations of isolated price analysis. The speedometer records the movement, but it does not initiate it.
Right.
Price tells you with perfect crystal clarity where the market has been, but it is completely incapable of telling you why the market moved. And if you don't know why a market moved, you have absolutely no logical basis for determining if that movement is sustainable.
Because you don't know if the driver's just tapping the brakes because they saw a pothole, or if they are pulling over to park the car for the night.
Right. Let's take it a step deeper into the market plumbing. Price cannot reveal the structural motivations behind capital allocation. It just shows you the result of orders colliding in an order book.
So you're just looking at the aftermath.
Yes. When you only analyze price, you are constantly trapped in a reactive state. You are reacting to outcomes. You see a green spike on a 5-minute chart. You assume momentum, so you jump in.
And then you see a sudden drop, you panic and sell.
Exactly. You're essentially chasing ghosts. The decision that caused that price movement, say the decision by a major fund manager to reallocate capital, that was made hours, days, or even months ago by someone looking at an entirely different set of information.
And yet there's a massive industry built entirely around this illusion. I mean, people build entire careers, they sell expensive courses, they program these complex algorithmic trading systems based purely on the idea that markets are self-contained ecosystems.
Oh, it's a huge business.
They genuinely believe that everything you could possibly need to know is embedded right there in that squiggly line.
Well, it's a deeply appealing belief because it radically simplifies the world. It is incredibly comforting to think you can sit in your living room with a laptop, open a charting software, draw a few geometry lines, and somehow conquer the global financial system.
Makes people feel smart.
It gives the individual trader a false sense of control. But it completely ignores the reality that markets do not exist in a vacuum. They aren't video games. Markets are embedded within a massive, complex, interconnected, global economic system.
Now here's where it gets interesting. Because if price is just the speedometer and it doesn't exist in a vacuum, we have to look at the engine.
We have to look under the hood.
Right, we have to look at the road conditions, the weather, the topography. We have to shift our focus away from the limitations of the lagging indicator, which is price, and look at the hidden ecosystem surrounding it. And that brings us to the macro.
The macro. It's a word that gets thrown around constantly on financial television, but honestly, it's almost always used incorrectly, or at least incompletely.
Okay, I'm going to interrupt you there because I really need to play the role of the frustrated retail trader for a second.
Go for it.
When you say macro to the average person, or even the average intermediate trader, their eyes immediately glaze over. And frankly, I don't blame them.
No, neither do I.
They think of incredibly boring, completely backward-looking data. They think of some government bureaucrat reading out last month's GDP figures or an inflation report that tells us what the price of used cars was 3 weeks ago.
Right. Stale data.
Exactly. If markets are supposedly forward-looking, how on earth does looking at stale, backward-looking economic data help anyone spot a live, developing trend in the market? Isn't trading off last month's CPI report basically driving through the rearview mirror?
If that were what macro truly was, your skepticism would be 100% justified. Trading off a headline GDP print from a month ago is a fool's errand.
Okay, good. So we agree on that.
But that is a profound mischaracterization of what macro actually means in a functional market context. Macro is not just a collection of stale economic indicators printed on a government press release.
And what is it?
In the reality of the global financial markets, macro is the absolute foundation. It is the physics of the market. We're talking about monetary policy regimes. We're talking about global liquidity availability, the actual plumbing of the financial system.
So not just the numbers, but the mechanics.
Yes, the mechanics. We're talking about structural capital flow patterns, offshore dollar availability, and massive geopolitical shifts that literally dictate supply chains.
So we're not talking about the weather report from yesterday. We're talking about the shifting of the tectonic plates beneath the ocean.
If we connect this to the bigger picture, macro operates as an incentive structure. That is the key phrase we need to lock in right now. Incentive structure.
Incentive structure, okay.
Macro dictates... Think about a core concept like interest rate differentials.
Okay, let's walk through that.
Let's say one country's central bank is paying 5% on their sovereign bonds, and another country's central bank is holding their rates at 0%.
A huge gap.
That macro reality creates a massive gravitational incentive. It fundamentally alters risk-taking behavior for anyone managing serious money. It acts like a magnet, pulling capital across borders.
Let me put this directly to you, the listener. Think about this logically, stepping outside of the day trading mindset for a minute. If you were an institutional portfolio manager overseeing, say, $50 billion of pension fund money.
Money that real people rely on for their retirement.
Exactly. Real stakes. Would you base your entire quarterly allocation strategy on a squiggly line crossing a 200-day moving average on a daily chart? Or would you base your moves on the fundamental structural incentives of the global economy?
The answer is obvious when you frame it like that.
Right. Would you look at a triangle pattern forming on an hourly chart, or would you look at the fact that the Federal Reserve is draining liquidity from the system through quantitative tightening, and the cost of capital is suddenly doubling?
A $50 billion fund cannot afford to care about a triangle pattern. I mean, they couldn't trade it even if they wanted to.
Why not?
Because their sheer size would destroy the pattern the very moment they enter the market. They care about yield. They care about risk-adjusted returns over a multi-year horizon. They care about deeply technical plumbing issues like repo market collateral constraints.
So they're playing a completely different game.
Completely different. They respond entirely to the macro incentives. And their collective immense response to those macro incentives is what actually creates the tidal wave of price movement that the retail trader ends up staring at on the chart weeks later.
Which perfectly sets up our next massive piece of the puzzle.
Yeah.
Because knowing that macro creates the structural incentives is really only half the battle. We also have to know who is actually responding to those incentives with enough financial firepower to physically move the global market.
We need to talk about the hidden architect.
Yes, the people actually pressing the gas pedal in our car analogy.
The institutions. These are the apex predators of the financial ecosystem. We're talking about central banks, massive asset managers like BlackRock or Vanguard.
Sovereign wealth funds, too.
Oh, definitely. Sovereign wealth funds managing the oil revenue of entire nations, and global macro hedge funds. These entities are the primary drivers of any sustained structural market trend.
And as we just established, they aren't sitting in a Discord server waiting for a chart to print a bullish engulfing candle before they deploy $10 billion.
Far from it. They operate on a completely different timeline and under a completely different mandate than an individual trader. They allocate capital based on those underlying macro conditions and their own strategic long-term objectives.
Right.
But here is the critical mechanical reality that most people miss entirely. They cannot just execute their trades all at once.
Right, because if I want to buy 10 shares of Apple, I hit buy at market and it fills instantly. Boom, done. But if an institution wants to buy $5 billion worth of an asset,
if a massive institution decides they need to move $5 billion into a specific currency or commodity, it can't just click a buy button. The sheer size of their order would completely distort the market order book.
it would be a disaster for them.
They would immediately consume all the available sell orders at the current price, and their remaining order would aggressively drive the price higher and higher until it was filled.
They would essentially be moving the price violently against themselves, ruining their own average entry price.
Exactly. They would suffer massive slippage. So to avoid this, they have to engage in a highly sophisticated process we call campaign formation.
Campaign formation. That sounds very deliberate, almost like a military operation.
A very apt comparison. A market campaign begins long before a trend becomes visible to the retail trader on a standard chart. It begins with that shift in macro conditions we just discussed.
So the conditions shift first.
Yes. The macroeconomic research teams at these institutions recognize a new incentive structure forming. Let's say they foresee a structural shortage in a specific commodity, maybe due to a lack of upstream capital expenditure over the last 5 years.
Okay, so they have a fundamental thesis.
Right. They present this thesis,
Yeah.
the portfolio managers agree, and then, very quietly, they begin accumulating their massive positions.
But wait, how do you hide an elephant in a room? If I'm looking at volume bars on my chart, shouldn't I see this massive buying?
Not necessarily, because they use specific execution algorithms designed specifically to hide their footprints.
Like what?
They use tools like TWAP time-weighted average price or VWAP, volume-weighted average price. These algorithms slice a massive multi-billion-dollar order into thousands of tiny microscopic orders and execute them slowly over weeks or even months.
Whoa.
Yeah, and they trade in dark pools, which are private exchanges where order books aren't visible to the public until after the trade is executed. They also source liquidity through over-the-counter or OTC networks directly with massive investment banks just to keep the volume off the lit public exchanges.
So they're essentially absorbing all the natural supply in the market without ever applying enough upward pressure to push the price up.
That's the goal.
They are buying the dips, quietly stepping in whenever the price drops a few ticks, completely staying under the radar.
Yes. The campaign exists structurally before it ever becomes visible visually. The capital is shifting. The foundation is being built. But if you look at the price chart during this phase, it looks completely flat.
Or maybe it's just chopping sideways in a really frustrating tight range.
Exactly. The uneducated observer, relying solely on price and volume indicators on a retail brokerage platform, sees absolutely nothing happening. But beneath the surface, structurally, a massive reallocation of global wealth is taking place.
But the real story is the absolute disconnect between when this institutional move actually starts and when you and I finally hear about it on the mainstream financial news. There is this massive, dangerous phenomenon that I want to call the narrative lag.
The narrative lag is arguably the single most dangerous trap for an uninformed market participant. It is literally the mechanism by which retail money is transferred to institutional money.
It's actually deeply ironic when you think about it. You turn on a financial news network at, say, 2:00 p.m., and you see analysts sitting around a desk confidently explaining why a market is surging today.
They always sound so certain. Always. They point to a specific news headline that dropped an hour ago or a specific data release, and they weave this incredibly compelling story. The market is up today because the CEO said this, or oil is surging because of this specific geopolitical headline.
But the reality is, the media narrative almost always emerges after the price has already moved significantly. They are trying to explain a trend once it is glaringly obvious to everyone.
Financial media operates essentially as historians, not forecasters.
Right. They see a massive price move on their terminal, and then they frantically scramble to find a macro justification for it to tell their audience, and this creates an incredibly powerful, false impression for the viewer at home.
It makes you believe that today's news headline is driving today's price movement.
Exactly. You start to think, well, if I can just react to the news faster, I can catch the trend. But in reality, the media is just describing the visible symptom of a structural process that was initiated by institutions months ago. By the time a macro narrative is widely accepted, neatly packaged, and blasted across the internet and social media, the institutions have already built their campaigns.
The smart money is fully positioned.
They bought during the boring sideways chop, and the retail traders buying now, based on the breaking news and the surging chart. They literally just providing the exit liquidity for the institutions to take their profits.
That is the harsh, unforgiving reality of market mechanics. If you wait for the narrative to be confirmed by the media and confirmed by a massive vertical green candle on your chart, you are already the mark. You are too late.
We need to make this incredibly concrete. We've talked a lot of theory so far. We need to prove this invisible campaign theory with a real-world application.
I agree.
Let's walk through a historical case study to show exactly how this plays out step by step, from the shadows of the institutional dark pools straight to the front page of the Wall Street Journal.
Let's do it.
Let's look at the anatomy of a trend, specifically using the currency market because currencies are just so deeply tied to macro.
The foreign exchange market is the perfect arena for this, specifically because currencies are driven almost entirely by macro policy divergence. Let's look at the massive move in the US dollar against the Japanese yen, the USD-JPY pair that began in early 2022.
Oh, that was a wild one.
It is a textbook masterclass in a macro-driven campaign, and we can break it down into 4 distinct phases.
Okay, take us back to phase 1, the origin point.
Phase 1 is where the macro shift emerges. The environment changes. Think back to late 2021 and early 2022. For years, major central banks around the world had very low, near-zero interest rates.
Free money, basically.
Right. But suddenly, inflation dynamics shifted violently in the United States. The Federal Reserve realized inflation wasn't transitory, and they had to pivot hard. They signaled they were going to start aggressively tightening monetary policy.
Meaning they were going to raise interest rates very quickly.
Exactly.
Right. Powell shifted his tone, and the market started pricing in aggressive rate hikes. But what was happening in Japan at that time?
Meanwhile, the Bank of Japan, led by Governor Kuroda at the time, was facing a completely different domestic reality. They had been fighting deflation for decades. So while the Fed was slamming on the brakes, the BOJ explicitly stated they were going to remain heavily accommodative.
They kept their foot on the gas.
Yes. They maintained their policy of yield curve control, essentially pinning their interest rates to the floor.
So you have the ultimate divergence. The Fed is hiking aggressively, creating a high-yield environment in the U.S., while the BOJ is artificially suppressing yields in Japan.
Exactly. This creates a rapidly widening interest rate differential. Suddenly, it becomes immensely more profitable to hold U.S. dollars because you can park them in U.S. treasuries and earn a safe 3, 4, eventually 5%.
And holding Japanese yen pays you what?
Essentially nothing. This isn't a chart pattern. This is the structural macro shift. It is an undeniable mathematical change in the incentive structure of global capital.
Okay, so the incentive is mathematically changed. The magnet has been turned on. That triggers phase 2.
Phase 2 is where institutional positioning begins in earnest. The massive players, the global macro hedge funds, the sovereign wealth funds, they have teams of analysts tracking these policy shifts.
They see the writing on the wall.
They see the divergence between the Fed and the BOJ cementing itself. They know exactly what this means mechanically, so they begin reallocating capital.
And this introduces a concept we hear a lot but rarely understand the mechanics of: the carry trade. How does that actually work in this phase 2?
A carry trade is beautifully simple in concept, but massive in execution. An institutional fund literally borrows money in Japanese yen, where the interest rate to borrow is roughly 0.
Okay.
They take those borrowed yen, sell them in the open market to buy U.S. dollars, and then invest those U.S. dollars in U.S. Treasury bonds yielding 4 or 5%. They are pocketing the difference, the carry.
Wow.
Now, multiply this strategy across dozens of massive funds dealing in billions of dollars.
They're structurally incentivized to aggressively sell the yen and aggressively buy the dollar. But this is the crucial part for our listener. While all these billions of dollars are flowing across borders in early 2022, what does the USD/JPY price chart actually look like? Are there massive green candles alerting the retail trader?
For a significant portion of this accumulation phase, it often looks surprisingly mundane. This is the essence of the campaign formation phase. The foreign exchange market is the deepest, most liquid market on the planet. We're talking trillions of dollars in daily volume.
So they can hide easily.
Exactly. Because the liquidity pool is an ocean, these institutions can slowly build their massive carry trade positions over weeks and months using those execution algorithms we discussed earlier.
So the chart is just boring.
The chart might look a bit choppy, it might slowly drift higher, but with plenty of pullbacks that shake out impatient traders. A purely technical trader looking at a 4-hour chart during this phase might see a series of failed breakouts or a messy consolidation zone. Their technical indicators are likely giving mixed signals.
So the foundation of the house is being poured, the structural beams are going up, but from the outside, the scaffolding hides everything. Which brings us to phase 3. The pressure builds to a breaking point.
Phase 3 is the price recognition phase. The institutions have largely built their positions. But the macro divergence hasn't stopped. It's accelerating.
The fundamental story is getting stronger.
Yes. The structural flow of capital out of Japan and into the U.S. becomes overwhelming. The supply of yen flooding the market simply exhausts all the available buyers, and the demand for dollars outstrips the available sellers.
The order book breaks.
The order book becomes completely unbalanced. And finally, the price breaks out decisively. It breaks through major technical resistance levels with absolute violence.
And this is when the technical traders, the people staring at the charts, suddenly wake up and smell the coffee.
Yes. The algorithmic trend-following systems, the momentum traders, the breakout traders who rely purely on price action, they finally see the movement on their screens.
The indicators flash green.
Exactly. They don't necessarily know or care why it is moving, but their moving averages cross, their MACD indicators flash green, so they jump in. And their participation acts as an accelerant. They pour gasoline on the fire, pushing the price even higher and faster, aggressively confirming the trend.
Here's where it gets really interesting. Because the average person, the retail trader managing a smaller personal account who gets their news from standard outlets, hasn't even realized what's happening yet. They are waiting for phase 4.
Phase 4 is narrative expansion. The trend is now glaringly obvious. The USD/JPY pair has been running hard for weeks, maybe months. It's up 15–20%.
All over Twitter.
It is now at the top of the financial news sites. CNBC is running segments on the collapse of the yen, and suddenly all the analysts and commentators are talking extensively about the central bank divergence. They explain the interest rate differential to their viewers as if it is breaking news.
Even though Powell and Kuroda clearly signaled this exact policy divergence 6 to 8 months ago?
Exactly. The macro explanation finally trickles down and becomes widely accepted by the public. Retail traders feel confident because the news is finally confirming the chart, so they buy in.
And the institutions?
The ones who recognized the macro incentive in Phase 1 and quietly built their campaign in Phase 2, they are already sitting on massive, life-changing profits. As the retail crowd rushes in to buy during Phase 4, taking on maximum risk at elevated prices, the smart money is using that massive influx of retail buying liquidity to quietly begin selling and closing out their positions.
That four-phase process macro shift, institutional positioning, price recognition, and narrative expansion is an absolute masterclass in how the financial world actually operates. The macro environment creates the incentive. Institutions respond to that incentive by allocating capital. Capital physically flows through the system, and price. Price is just the final tally on the scoreboard, revealing who won the game.
It completely, fundamentally destroys the idea that price initiates anything.
It shatters the illusion. And once you truly understand this sequence, you start to see the fatal flaws of a price-first approach to trading. It's not just a suboptimal way to analyze markets. It is actively, structurally detrimental to your capital.
It really is.
Let's analyze those specific failures. We've seen how the smart money operates in the shadows. Now we need to look at the very specific traps that catch the retail traders, who stubbornly refuse to look at anything but their candlestick charts. Let's start with the first major flaw, which we just touched on: systemic late entries.
Right. When you rely strictly on price confirmation, you are mathematically guaranteeing that you will be late to the real move. You are waiting for the trend to become obvious.
You want to feel safe.
Exactly. You want to see a clear breakout, a retest, and a continuation before you commit your capital. But as we just mapped out in the currency example, by the time price action provides a clear, undeniable textbook technical signal, the early, most profitable institutional positioning has already occurred. The easy money has been made.
You are essentially demanding that the market prove itself to you before you take a risk. But the market is ruthless. It charges a steep premium for certainty. The more certain a trend looks on a chart, the worse your entry price is going to be.
That is the trade-off. You are entering market right when the risk-reward ratio has severely deteriorated. You are buying high, hoping the momentum continues and it goes even higher.
Which is incredibly dangerous.
But you are doing this right at the exact moment when the early institutional adopters are looking at their massive unrealized gains and thinking about taking profits. This leaves the technical breakout trader incredibly vulnerable.
Because if the institutions start unwinding their positions,
the market will suffer sudden consolidations or violent reversals, and the latecomer is immediately trapped in a losing position.
And that leads perfectly into the second fatal flaw of price-first analysis, which I honestly think is the single thing that drives most traders completely insane and blows up most accounts: misinterpreting noise.
Oh, noise is a killer.
I want to spend some time here. What exactly is market noise? And why does a trader who only looks at price fall victim to it so often?
It's a critical concept. Noise is simply short-term price fluctuation that has absolutely no underlying structural backing. It's not driven by macro shifts. In any deep liquid market, you have thousands of participants interacting at any given second for thousands of different, often conflicting reasons.
Like who?
You have market makers algorithmically hedging their options books, what they call delta hedging. You have multinational corporations repatriating profits across borders just to pay their quarterly taxes. You have day traders closing out leveraged positions before the weekend to avoid overnight risk.
None of these participants care about the long-term trend.
Right.
They're executing administrative or mechanical tasks.
Exactly. But their actions create constant minor imbalances in supply and demand in the order book. A large corporation dumps a bunch of currency to pay a supplier. The order book briefly empties out on the bid side, and the price drops quickly.
They create the sudden, scary little wiggles on the intraday chart.
Yes. But here is the fatal problem for the technical trader. If you do not have a macro context anchoring your worldview, you have no filter. Every single wiggle on the chart looks like a potential signal.
You react to everything.
Right. A sudden 50-pip drop caused by a single large fund mechanically liquidating a position looks exactly like the terrifying beginning of a massive structural market crash if you are zoomed in on a 5-minute chart.
So the price-first trader sees that sudden drop, Their RSI indicator plunges, their moving averages cross downward, they panic and sell their long position. Or worse, they immediately switch bias and short the market at the bottom, thinking they're catching the start of a new downtrend.
And then what happens? 10 minutes later, that temporary liquidity imbalance is resolved. The corporation finished its transaction. The dominant macro-driven institutional campaign resumes buying. The price rockets right back up, and the retail trader is stopped out for a loss.
Whipsawed.
They were completely whipsawed. They mistook a temporary, meaningless liquidity event for a structural change in the market. When you have no macro filter, you try to trade every wiggle. This leads to massive overtrading, immense psychological frustration, the slow bleeding of trading capital through 1,000 tiny cuts, and just wildly inconsistent performance. This raises an important question.
Go ahead.
If short-term noise looks geometrically identical to a genuine structural shift on a chart, how can any trader tell the difference? Let's say I'm looking at a daily chart and the market drops 3% in 2 days. How do I know if that pullback is just a healthy temporary pause where the market is breathing in a bull trend, or the terrifying beginning of a massive bear market?
That is the absolute crux of the issue. That is the question every trader struggles with. And the hard truth is a purely price-based framework simply cannot tell you the difference. It is structurally impossible.
Right, because a healthy consolidation phase, where institutions are taking a breath, taking some minor profits, and absorbing new supply before pushing higher, looks geometrically identical to the early stages of a major trend reversal.
If you are only looking at the geometry of the candlesticks, you are guessing. You are flipping a coin and hoping your stop loss holds.
But if you know the macro,
If you know the macro, you possess the context. You know the underlying drivers. Let's go back to our weather analogy. If the fundamental incentives, the central bank policy, the liquidity conditions, the growth dynamics, are still pointing strongly in one direction, then you know the structural campaign is highly likely still intact.
therefore, a sudden 3% pullback in price is interpreted not as a panic signal, but as a temporary consolidation, or even a gift, a better entry point.
The macro context gives you the conviction to hold your position through the noise.
Or even tactically add to it, while the price-only trader is panicking and throwing their shares away at the exact wrong time.
So what does this all mean? If we synthesize the flaws, it means that relying entirely on price confirmation is a recipe for long-term failure. It means you are mathematically destined to enter trends late. It means you are constantly dealing with terrible risk-reward setups where your stop loss is miles away.
And you are constantly getting faked out by normal market breathing.
Trapped in a cycle of buying the top when it looks the most bullish and panic selling the bottom when it looks the most bearish, all because you have no fundamental anchor to tell you what is actually real.
It means you are playing a high-stakes game where you have deliberately blindfolded yourself to the underlying rules. You are trying to navigate an ocean by only looking at the surface ripples, completely ignoring the massive underwater currents that actually dictate where the water is going.
Let's zoom out for a second because I want to be very careful here, make sure our listeners don't misinterpret our core message. We have spent the last 30 minutes systematically tearing down price-only analysis. We've exposed its deep flaws.
Yes, we have.
But we are not telling you to take your monitors, throw them out the window, delete your brokerage app, and never look at a candlestick chart again. We aren't saying price is a useless tool.
Not at all. That would be a massive overcorrection. Price is an absolutely essential component of a professional trading methodology, but its role must be properly defined and strictly compartmentalized.
The error that retail traders make is not in using price.
No, the catastrophic error is in using price as the foundation of their analysis.
So how do we actually build the right framework? If price-first thinking is flawed, what does a highly functional integrated framework look like for a trader who wants to operate like a professional?
The rule is elegant but strict. Macro first, price second. Macro is the foundation, price is the confirmation. You always begin with macro to establish your directional bias.
You do the deep work first.
You do the deep work. You analyze the central bank policies, the yield curves, the liquidity flows. That macro analysis tells you the structural path of least resistance. It tells you unequivocally whether the global current of capital is flowing north or south.
It tells you what the institutions with the big money are mathematically incentivized to do.
Exactly. But here is the limitation of macro. Macro cannot tell you exactly when the market is going to move. Macro is a blunt instrument. It is notoriously terrible for precise timing.
Because it takes so long to play out.
Right. You can have the absolute correct macro view. You can foresee a structural shortage in copper, but you could be early by 6 months. The market can remain irrational or simply sleepy longer than you can remain solvent if your timing is wrong.
And this is exactly where price becomes your most valuable, indispensable tool.
Yes. Price provides the precise timing. It allows you to track exactly how the institutional campaign is progressing in the real world.
I promised myself I wouldn't use too many analogies, but I have to bring back the weather forecast because
Yeah.
I think it perfectly bridges this gap.
Go for it.
Your macro analysis is the deep meteorological data. It's the satellite imagery. It looks at the jet stream, the atmospheric pressure systems, the cold fronts slowly moving across the continent. That deep macro data tells you, with a very high degree of probability, that it is going to be a brutal, freezing winter. That establishes your directional bias.
Right.
Without a doubt, you need to prepare for snow. You shouldn't be buying beach umbrellas.
But the satellite meteorological data won't tell you if the first blizzard is going to hit your specific town on Tuesday at 2:00 p.m. or Thursday at midnight.
Right, so looking at the price chart is the equivalent of looking out your living room window. You don't stare out your window to figure out the global climate. That would be absurd.
You'd learn nothing about the climate.
You look out the window to see exactly when the first snowflake actually starts falling from the sky. You use the window, the price action, the volume profile, the order flow as a diagnostic tool to ask a very specific question. Is the immediate market weather acting the way my macro forecast predicted?
That is exactly how a professional portfolio manager or proprietary trader uses price. They spend 80% of their time establishing the structural environment first. Then, they watch the price behavior contextually.
They wait for the confirmation.
Exactly. If their macro thesis is bullish, they aren't just blindly buying, they wait. When price begins to structurally break out in the direction of their macro bias, breaking through resistance with strong volume, that is their confirmation.
It validates the underlying thesis.
It validates it. It tells the trader, the institutions are finally moving aggressively, the campaign is entering the visible recognition phase, the tide is coming in, now is the exact time to execute the trade to maximize capital efficiency.
And what happens if the price moves against the macro bias? Let's say the macro says bullish, but the chart suddenly drops 5%.
Then you have been handed a critical piece of information that requires immediate interpretation. You don't panic, but you ask yourself a very disciplined question. Is this sudden drop a temporary deviation caused by short-term noise, like a market maker hedging or a random news headline? Or did I miss a fundamental shift in the macro environment? Did a central bank secretly intervene? Did a geopolitical event just destroy supply lines?
It forces you to actually think.
It forces you to actively reevaluate your fundamental premise, rather than just blindly following a moving average crossover to your doom. Separating these roles, strictly using macro for direction and price purely for timing execution, drastically improves market clarity.
It virtually eliminates the reactive, emotional, fear-based decision-making that plagues so many retail traders.
It really does.
Okay, we have laid out the logical framework. It's clean, it makes fundamental sense, and quite frankly, it is the only approach that aligns with the actual physics of how global capital flows. But human beings are rarely logical creatures, especially when their own money is on the line.
Very true.
There is a deeply ingrained reason why millions of people still cling desperately to their purely technical charts despite blowing up account after account. So before we wrap up, we really need to dive into the psychology of the trader. Why is this macro-first approach so incredibly difficult for the average person to adopt?
It is intensely difficult because it runs entirely counter to human evolutionary cognitive bias. Our brains are hardwired for survival in a primitive environment. We are wired to seek patterns in chaos, to seek absolute certainty, and above all, to desire immediate feedback for our actions.
And deep macro analysis offers absolutely none of those psychological comforts.
None of them. It requires a massive mental shift. You have to unlearn almost everything you naturally want to do. First and foremost, macro analysis is inherently interpretive and nuanced. It does not provide clean mechanical rules.
Right. A technical indicator like an RSI or a MESED will give you a hard mathematical number.
It will objectively tell you the RSI is at 72, therefore it is overbought. It gives you a rigid binary rule buy here, sell there. It requires no deep thought, no synthesis of complex ideas. Macro analysis, on the other hand, requires synthesizing incredibly complex, sometimes entirely contradictory global variables.
Like, you might have bullish liquidity conditions, but bearish growth data.
Exactly. It requires subjective judgment, historical context, and probabilistic thinking.
It requires you to be comfortable operating in the gray area.
Sure.
And people universally hate the gray area. We want the world to be black and white. We want a guru to tell us, if X happens, do Y.
Yes, the cognitive bias towards simplicity is overwhelming. We desperately want a clear, unambiguous system that removes the burden of decision-making. A chart with perfectly drawn red and green arrows gives us a profound, albeit entirely false, illusion of precision and control.
It makes us feel safe in an inherently unsafe, chaotic environment.
Macroanalysis strips away that comforting illusion. It forces you to sit with uncertainty and immense complexity. It forces you to accept the humbling reality that the global market is a chaotic system driven by the aggregate behavior of millions of humans and massive geopolitical events, not a simple math equation that can be neatly solved with a Fibonacci retracement tool.
But I think the hardest part, the real psychological torture of macro trading that breaks most people, is the delayed feedback loop.
Without question. Human brains are heavily optimized for immediate cause and effect. It's how we learn. If I touch a hot stove, it burns me immediately. I feel pain. I learn the lesson instantly.
But the market isn't a stove.
Well, if I execute a purely technical trade based on a 5-minute chart breakout, I know within 10 or 15 minutes if I was right or wrong. I either hit my profit target and get that massive immediate dopamine hit, or I hit my stop loss and feel the immediate sting. The cycle is closed quickly.
But macro moves at the speed of a glacier.
Exactly. You can do the deep, exhausting intellectual work. You can identify the massive structural shift in global dollar liquidity. You can perfectly anticipate the institutional incentives. You put your trade on, and then you wait.
And you wait some more.
You might have to wait 3 weeks, 3 months, or even 6 months before the price actually breaks out and confirms your thesis. Operating in that void, sitting with a position that is flat or slightly down, without the immediate validation of price moving in your favor, is deeply, deeply uncomfortable for the human brain. It induces massive anxiety.
You watch the chart every single day, and nothing happens. Or worse, it chops around and temporarily moves against you because of short-term noise. You start questioning your own sanity. You start wondering, am I the only one who sees this macro picture? Am I crazy?
It's a mental game.
It takes an almost ironclad psychological discipline to trust the invisible structural reality of the macro data when the highly visible, flashing red reality of the price chart is screaming at you to close your position and run away.
That specific discipline, that ability to delay gratification and trust the deeper structure over the immediate visual stimulus, is the ultimate dividing line between those who simply gamble in the markets and those who truly understand how to extract wealth from them. You must overcome the primal dopamine-driven urge to react to the visual stimulus of short-term price action.
Which brings us to our final synthesis. We've covered a truly massive amount of ground today, pulling back the curtain on the plumbing, the hidden architects, and the psychology of how this whole financial machine actually operates. Let's do a rapid-fire summary to lock this all in for our listeners.
The foundational, unshakable truth of this. Markets are driven entirely by the flow of capital. Capital is not sentimental. It has no loyalty. It responds strictly to mathematical incentives.
And those incentives are shaped by macro conditions.
Yes. Central bank policy, global liquidity constraints, and economic growth trajectories. Institutions, the entities with enough size to actually move the needle, react to those macro incentives by slowly and methodically building massive campaigns.
And price.
Price is just the final tally on the board. It is the lagging, trailing indicator of a structural process that is already complete.
I want to leave you with one ultimate analogy that I think perfectly captures everything we have discussed in this deep dive. Think about a physical object, say a large tree, casting a shadow on the ground as the sun moves across the sky. The tree is the macro reality. It is the solid three-dimensional truth of global capital flows, interest rates, and institutional positioning. The shadow moving across the grass, that is the price chart.
That is a brilliant and highly accurate way to visualize the relationship.
If you spend your entire life analyzing only the shadow, measuring its exact length, looking at how it shifts and warps over the bumps in the ground, trying to predict its next move based on its past shape, you might convince yourself you understand it.
But the shadow has absolutely no substance.
Right. It has no mass. It cannot move on its own. It is entirely 100% dependent on the object casting it and the light source above. If you spend your life chasing the shadow, you will always, by definition, be a step behind. You are reacting to a distortion of reality, not reality itself.
Traders who begin and end their analysis with price are shadow chasers. They are constantly reacting to outcomes, constantly trying to interpret a distorted, delayed reflection of reality. But traders who begin with the macro foundation, they are looking directly at the object itself.
They understand the light source.
Yes. They are positioning their capital alongside the massive structural forces that actually dictate where the shadow will eventually fall.
They aren't trying to magically predict the future with a crystal ball. They are simply reading the present structural reality of capital so deeply and accurately that the future price action becomes almost inevitable.
And that is the final forward-looking perspective I want to leave every listener with today. The absolute next time you open your brokerage account, pull up a chart, and you see a massive, violent market move, a huge red candlestick dropping off a cliff, or a green candle exploding to all-time highs, stop yourself. Break the habit.
Don't just react.
Do not ask, what is the chart doing? Do not immediately look for the geometric pattern or check if your RSI is overbought. Instead, take a breath, zoom out, and force yourself to ask a completely different, much harder question. What structural incentive shifted in the real world to make billions of dollars of capital flow this way with such undeniable force?
What changed the gravity of the market?
Exactly. By learning to read the underlying incentives rather than agonizing over the shadows, you stop reacting to what has already occurred. You step out of the exhausting emotional reactive cycle of the retail trader, and you start positioning yourself alongside the silent forces that are actively creating the future.
Because until you put in the work to understand the language of the underlying structure, you'll just be staring at that screen, watching the line go up and down, forever feeling like you're trying to read a language you don't understand.
It is time to learn the actual language of the market.
Thank you for joining us on this deep dive. Put down the technical manuals, start studying the plumbing, and start looking at the object, not the shadow. We'll see you next time.